Chapter 4 covers financial services and savings and payment plans. Here are the learning objectives for Chapter 4. I know you can read them, but I will too, just to be clear about what we want as takeaways from this chapter. We want to identify commonly used financial services, compare the types of financial institutions, assess various types of savings plans, and look at different types of payment methods. Ways of saving, and particularly of paying, have changed significantly over the last decade. Connecting with a teller via video, transferring money via an app, depositing checks from an app on your phone, using mobile payment systems to pay a person via Venmo or a company via PayPal, the company's website, or your bank's online payment system. We write very few checks these days. We just don't need to anymore. Exhibit 4.1 in your text gives a graphic representation of the types of financial institutions and the services available. Starting at the top, the ones we're probably most familiar with: deposit institutions, commercial banks, and credit unions. Going counterclockwise to the left, non-deposit institutions also offer a variety of financial services. These include credit card companies, life insurance companies, investment companies, and finance companies. On the right, other financial service providers include pawn shops, check cashing outlets, payday loans, and rent-to-own centers. Finally, at the bottom, non-bank financial service providers include retail stores, online banking, and payment services like PayPal and peer-to-peer lending. We'll look at each of these types of institutions in more depth on the following slides. Various financial services are used to meet daily and long-term financial needs. Managing your money means watching what you do on a daily basis. Common mistakes include overspending. Just about everybody does it at some time. It's easy to $10 yourself to death. Insufficient liquid assets, not having enough cash available in an emergency. Paying current expenses out of savings or borrowing to cover those expenses. Failing to earn interest on unneeded liquid assets. Remember, your goal: increase net worth, which means save more, owe less. So where can you get quick cash when you need it? Well, you could take it out of savings, or you could cash in a CD or mutual fund shares, or you could borrow the money. Problem: either option reduces net worth. So what types of financial services are available? Savings. These are time deposits, savings and CDs. Payment services, checking accounts, or demand deposits. You can set up automatic payments through your bank. Short or long-term borrowing. Some other specialty services: insurance, investments, real estate, tax assistance, trust, financial planning. An asset management account is a very popular type of investment account. It's also called a cash management account, and it frequently includes a checking account, an ATM card, a credit card, online banking, a line of credit, and investment access. Online banking offered by virtually all large commercial banks and many credit unions. Does anyone actually get a paper paycheck anymore? Direct deposit is so much more convenient for you and for your employer, and the money's in your account immediately on payday. You can set up automatic payments and reminders for recurring bills like gas and water, a car note, home mortgage. You can set up an automatic savings plan that transfers a set amount to a savings account every week or every month. Almost as good as having it taken out of your paycheck before you get it, a painless way to begin saving. Everyone needs cash from an ATM periodically. Using your own bank's ATM is usually free. Using other ATMs can carry a fee. Debit cards can help overspenders get control. No money in your account, you can't buy anything, period. The downside of a debit card is it builds no credit record, as we'll see when we look in Chapter 5. This slide just recaps the services available online and via mobile banking. Under Payments and Transfers, the newest option is the next to last one: using your phone to make a purchase. Apple Pay, Samsung Pay, Android Pay. Note, research has found that using your phone to pay is faster than a chipped card and more secure. Deposits online are still somewhat new and may incur a fee for fast access, but most other services are free and readily available. Basically, with your bank's app, you can control your entire banking needs via phone. Depositing checks, the few you get, from your phone is a huge time saver. Prepaid debit cards are offered by a variety of financial institutions and even retailers such as Walmart. The major advantage is that it's a pay now, buy later, resulting in a lower consumer debt versus credit cards' buy now, pay later model. But beware, the fees attached can be significant. Watching current rates and expected directions helps you make smart financial decisions. If rates are expected to rise, long-term borrowing, lock in the low rates. Short-term savings, wait for higher rates. If you think they're going to go down, short-term borrowing, wait for the rates to fall. Long-term savings, lock in the higher rates now. Common sense, but you have to watch current rates and pay attention to what the Federal Reserve is doing and saying to be aware of the expected direction of rates. The options for where to obtain financial services has expanded well beyond traditional commercial banks. Comparing financial institutions is a personal decision. Depends on which services you need, which you use the most, what's important to you. High return on your savings, minimum cost for services, availability of loans. Step 1. The first step in any financial decision is determining what your needs are. What's important to you? Which services do you need? Savings, checking, loans, mobile app? What are the fees? Minimum balance requirements, ATM fees. Convenience. Assuming you have to actually go to the bank, is there a branch convenient to your home or office? How easy is it to bank online? Step 2. Rank these and then start looking for institutions that meet your needs. Once you have a clear picture of what you're looking for in a financial institution, check out the available options. Don't neglect smaller local banks. They can offer very attractive rates and hometown services. Ask friends whose opinion you trust, where they bank and are they happy with their bank. A personal visit to a bank can give you a good feel for how you'll be treated as a customer. Step 5. Choose the best fit for you. You can use more than one institution to obtain the best services for you, but balance the rate services versus the convenience of using just one institution. Having a main bank where you have all your accounts can have benefits if you need personal help, say having a fee reversed that you think was unfairly charged. The bank may agree to do it to keep you as a customer. Finally, if you decide to change banks, there are switch kits available to make it easier, especially changing direct deposits and automatic payments. This comparison chart in your text can help guide your selection. It compares the basic features of 4 types of financial institutions: large-scale banks, regional community banks, credit unions, online banks, in terms of benefits and drawbacks. So, in looking for a financial institution, what types are out there? Deposit institutions, as the name implies. They take deposits. Commercial banks are the most common. They're organized as corporations. They typically offer a full range of services, including deposits, loans, and investments. These are the main banks that have been around forever, around here: Regions, First Horizon. Savings and loans, not that many of them left after the S&L crisis in the 1980s to 90s. Generally operated like a commercial bank, but their primary focus is home mortgage loans. Mutual savings banks, not many of these around either. Northwestern Mutual has a mutual bank subsidiary. The key point is the bank is owned by the depositors. And credit unions. These are user-owned. They're non-profit, lower fees and rates. They're typically associated with a business or an organization. Teachers Association, Navy Memphis, FedEx. First South is not company affiliated. If you're eligible to join one, do so. The rates are usually lower than available anywhere else. The term financial institutions also includes non-depository firms, life insurance companies. Some also offer savings and investment programs as well as financial planning services. Investment companies offer mutual funds and money market funds, but they're not covered by FDIC. Brokerage firms also act as non-depository institutions. Credit card companies do offer short-term loans. Finance companies, high-rate short and medium-term loans. Mortgage companies offer home mortgages. A few financial options are, to say the least, problematic. Pawn shops. They're a source of quick cash for possessions, but the fees are high. Check cashing outlets, also known as currency exchanges, they charge a fee on face value. More problematic, desperation level options. Payday loan companies, cash and check advances, very high interest rates. Rent-to-own centers, high interest rates. Car title loans. Do I need to explain this one? Very high rates. The maximum loan in Tennessee and Mississippi is $2,500. Regular so-called passbook savings is the most common. Virtually no minimum balance, but very low rate of return. Easy withdrawal and insured. Most of us probably started with a savings account as children. A savings account at a credit union is termed a share account, since you're basically a shareholder in the credit union. CDs are typically time deposits in the sense that there's a time on it and a penalty for early withdrawal. There's also usually a minimum deposit. The funds must be left for the entire period or incur a penalty for withdrawal. Wide variety of types to fit all needs, offered with usually higher rates for longer terms. You can see the list of CD names on the slide. We won't go over each type in our short class, but it's obvious. If you want to consider a CD, there's probably one that fits your needs. Be sure to understand the rates and fees involved carefully. Do not allow your bank to automatically roll your CD over without doing due diligence on current rates and fees. Consider creating a portfolio of CDs with more or less laddered maturity dates. Exhibit 4.5 in your text. This graphic recaps the pros and cons of the savings alternatives we've covered. Regular savings accounts, low minimum balance, ease of withdrawal, and they're insured, but low rates of return. CDs, guaranteed rate of return, and they're insured, but there's a minimum deposit and a penalty for early withdrawal. Money market accounts and funds, favorable rates, and they're insured, and frequently allow a minimum number of checks to be written, but they require higher minimum balance, and they charge a fee if the balance drops too low. Money market funds are not insured. Finally, U.S. savings bonds, I-bonds. The rate varies with inflation. It requires a low minimum deposit, they're government guaranteed, and they're exempt from state and local tax. But the rate of return is lower if it's redeemed within the first 5 years. Money market accounts and funds sound the same, but they aren't. Both have floating interest rates and allow some check writing, but accounts are insured. Money market funds are not. U.S. savings bonds, frequently bought as gifts for children. Series EE bonds, they are the original zero coupon bonds, sold at half face value, very low minimum, they pay a fixed rate, and they can earn interest for up to 30 years. I-bonds are indexed, paying a fixed rate plus an inflation premium adjusted twice a year. Individuals can purchase Treasury securities online via Treasury Direct. For a savings plan, rate of return can be critical. Rate of return or yield means the percentage increase due to interest earned on interest, compounded. Truth in Savings Act requires that both lenders and depository institutions disclose the interest rate paid or charged in a specific format. Here are the 6 criteria for selecting a savings vehicle. This is Exhibit 4.6. Rate of return. Inflation makes fixed rate interest earned worth less. Taxes. It reduces your earnings. Liquidity. How fast can you convert to cash? Safety, risk and insurance. Restrictions and fees. Minimum balance requirements are the most common and can vary widely, as can fees for additional services. We'll look at each of these criteria briefly on the following slides. As we looked at in reviewing time value of money, more frequent compounding increases the future value. Annual yield for 4% annual is 4.08 if compounded daily. As should be obvious, higher interest rate, higher future value. Longer time on deposit, higher future value. Annual percentage yield, APY, is defined as the total percent. The total percent is based on annual interest and frequency of compounding. The Truth in Savings Act requires that both lenders and depository institutions disclose the interest rate paid or charged in a specific format. APY is annual percentage yield, APR is annual percentage rate. In either case, the rate is the periodic rate times the number of periods per year. So if a lender charges 5% per month, the APR is 5% times 12, 60%, and that's the rate they have to quote. Here's an example and an alternative formula. If $66 is earned in a year on a $1,200 deposit, then the APY is 5.5%. What to consider when looking at a savings plan? Inflation. Inflation reduces the value of interest earned. In evaluating returns, compare them to the rate of inflation, current and expected. Taxes. Like inflation, taxes reduce earned interest, The higher your tax bracket, the higher the hit. Liquidity. Liquidity has two dimensions, equally important. The ability to convert an asset to cash quickly without significant loss of value. You can sell anything quickly if the price is low enough, so the second dimension is critical. Safety. FDIC insures up to $250,000 per person per institution. NCUA, National Credit Union Administration, covers credit union accounts. And restrictions and fees. Minimum balance requirements are by far the most common. Some accounts charge by transaction or by check written. Paper checks are quickly becoming an antique. It's so much easier to pay your bills online, yet most of us still have a checking account, as there are times when you just need to write a check. As shown in Exhibit 4.8, payment alternatives have three categories. This chart compares three general payment methods: digital, debit and credit, online payments, prepaid store, smart cards, peer-to-peer, checking account, handwritten checks, and other, cashiers and certified checks, money orders, and traveler's checks. You don't see those much anymore either, as travelers simply use their credit cards. We'll look briefly at each. Debit card transactions. We've already talked about these. It's an immediate deduction from your linked account, but it builds no credit history. Online payments. PayPal definitely changed online buying by offering a safe way to transact with people and companies without knowing them. What started with eBay has expanded so that many online retailers accept PayPal. Mobile transfers. A variety of other online payment and peer-to-peer services have been developed. Allows the direct transfer of funds from your bank account or credit card to another person. PayPal, Google Wallet, Venmo. Be careful. With your credit card, you're protected somewhat against fraudulent access. Not so much with your bank account. Stored value cards. These are just basically prepaid cards. Telephone and tolls are common. Gift cards fall in this category. And smart cards. We're moving in this direction with chipped cards. The talk now is that this will expand with fingerprint ID cards. The credit card versus debit card debate. A credit card makes sense if you want to delay payment, you need to build a credit history, you're buying online, it's a major purchase, you want to earn reward, you need to book a car or a hotel room. A debit card makes sense if you want to control your spending, you want to avoid future bills, you want to avoid interest payments or fees. It's better protection than versus a credit card. Checking accounts fall into three major categories. A regular checking account. For years, this was the standard way to pay monthly bills. Write a check and mail it. Minimum balance is usually required to avoid monthly charges. Still, having the ability to write a check is still sometimes required, unless you choose to deal 100% in cash or credit. Activity accounts. These are low-activity checking accounts with a fee charged for each check written. If you just need a basic account and you don't want to maintain a minimum balance and just write few checks, this could work for you. Interest-earning accounts. Banks and credit unions offer interest-bearing checking accounts, but these do typically require minimum balance. This is Exhibit 4.9 from the text. It's a chart recapping the decision criteria for selecting a checking account. Pay particular attention to minimum balance requirements, be sure the account's insured, monthly fees and specialty fees, availability of ATMs, and the availability of online banking, direct deposit, and any fees that are involved with that. Continuing our look at checking and payment methods, beware of package deals. They may charge you for services you neither need nor want, but you'll be paying for them. There are other payment methods, though most are infrequently used. Certified checks and cashier's checks. Both include guaranteed payment for a fee. Note that cashier's checks can be canceled, but certified checks are harder to stop payment. Certified checks, cashier's checks, and money orders allow payments that the recipient knows is valid, which, for example, would be useful when you're buying a used car from someone who doesn't know you. Money orders can be purchased at post offices and many stores. Traveler's checks used to require double signing, once at issue, again when they were used. They're not used much now since credit cards are widely accepted all over the world, and traveler's checks are actually issued in credit card form, usable at ATMs. Assuming you decide you do need a checking account, opening the account. Individual, your name only, joint, be careful of and, use or. It can be a spouse or a parent. Endorsing checks for deposit. A blank deposit is a signature only. Once signed, it's negotiable by anybody. Restricted for deposit only with an account number. Special pay to the order of transfers the check to a third party. They're not widely accepted. The remote deposit allows you to deposit a check from your phone. What do you record? The date, who you write it to, the amount in figures, the amount in words. Don't forget to sign it, and note the purpose in the for line. Reconciling your bank account. Compare your record of checks written against the list of checks cleared on your bank statement. Subtract checks written but not yet cleared. Add deposits not yet shown on your statement. Subtract fees or charges and ATM withdrawals. Add any interest to your checkbook total. This should balance your checking account. If it doesn't, go back and recheck everything. Contact your bank if you cannot find the discrepancy. They can make mistakes. You definitely should reconcile your checking account every month. This is a window into your spending habits. You need to be sure all deposits have been posted, and you should definitely check any ATM withdrawals to be sure they're you. You want to be aware of any fees your bank is charging you. If you find an error, do not hesitate to ask your bank to resolve it. It's your money. We'll walk through a bank reconciliation example. The bank statement balance is $920. Your checkbook says $1,041. Does it balance? Looking at the bank statement, $920. Subtract outstanding checks on the worksheet not cleared, $187. Add a deposit that's in transit, $200. Adjusted balance, $933. On your checkbook, $1,041. Subtract fees and ATM withdrawals, minus $271. Add online interest, $163. Checkbook balance, $933. We're balanced. Summarizing the chapter. These slides go over the 4 learning objectives. Identify commonly used financial services. We covered all the basic ones. Savings plans, checking accounts, loans, electronic banking. We'll cover trust in Chapter 14. Compare the types of financial institutions. We covered a variety of types of financial institutions and the criteria to compare them. Assess various types of savings plans. This recaps the types of savings plans and the criteria for evaluation. Evaluate different types of payment methods. As with savings plans, we covered basic payment methods, the most common being debit and credit cards and regular checking accounts. This ends Chapter 4.